In Philippine capitalism, families shape entire ecosystems. The Lopez Group, with Rockwell Land and ABS-CBN, offers a compelling lesson in how success and struggle coexist, even within a single orbit of influence. On one hand, Rockwell presents robust results. Net income up 29% to 5.3 billion pesos, revenues climbing to 20.9 billion pesos, and an impressive EBITDA margin of 42%. Reservation sales soared, and the acquisition of Alabang Commercial Corporation added fresh scale. Yet beneath these headline numbers lies a caveat. A one-off gain from the ACC purchase lifted profits, flattering an otherwise steady year. It's not just earnings that matter here, but the shifting weight of its balance sheet. In 2025, Rockwell's assets grew 58% to 129.2 billion pesos, while liabilities surged 77% to 81.5 billion pesos. Debt increased sharply, with the net debt-to-equity ratio rising to 0.77x. 45% of that debt is floating rate, an uncomfortable position in unpredictable interest environments. Liquidity is now a central concern. Rockwell generated just 2.0 billion pesos in operating cash flow last year, but invested over 12 billion pesos in projects and acquisitions. Funding relies on a blend of internal resources and external borrowing, a balance that is sustainable only as long as markets remain tranquil and lenders cooperative. Management acted swiftly, securing a top-notch credit rating and raising 10 billion pesos with bond issuances to diversify its refinancing options. The discipline required is greater now. Frequent trips to the market are the new norm. A developer once reliant on project cash flows must now pass repeated credibility tests with lenders. Contrast this with ABS-CBN. Still burdened by years of losses and heavy liabilities, current ratios remain weak. A stark reminder of what happens when liquidity becomes a chronic issue. Conditional loan waivers, urgent refinancing, and shrinking equity signal a company in covenant breach limbo. Not insolvent, but not in steady credit territory either. Psychological contagion, not legal, becomes the real risk. Lenders don't just analyze numbers, they observe family patterns. When one subsidiary is forced to negotiate waivers, precedent shadows every group company. It means creditors will scrutinize Rockwell's leverage and liquidity buffers more closely, aware that even premium subsidiaries may face tighter scrutiny. For now, Rockwell remains the healthier patient, with strong earnings power and a growing stream of recurring commercial income. The ACC acquisition adds valuable leasing space, supporting stability over time. But the margin for comfort is narrower than the headline growth reveals. The lesson is clear. In Philippine conglomerates, the first signal of risk is seldom dramatic. It grows quietly, in liquidity ratios, refinancing schedules, and the silent calculation of every lender. The challenge ahead is to digest acquisitions, maintain sales momentum, and keep lenders confident, all at once. Success will require not just strategic ambition, but patient financial discipline. For investors and analysts, the message is subtle yet urgent. Watch the liquidity, understand the ecosystem, and remember that even polished brands must constantly earn market trust.